Welcome to Tim Talks Private Equity and Venture, where Tim Cunningham sits down with leading GPs and private markets professionals to explore the dynamic world of private capital. Since 2002, Tim and his team at Touchstone Group have been at the forefront of raising capital for buyout, growth, and venture funds. With decades of hands-on experience working alongside private equity and venture LPs and GPs, Tim brings deep industry insight and expertise to every conversation. Join us for candid discussions with GPs who are shaping private capital today. Now here's Tim.
Hey everyone, this is Tim Cunningham. Welcome to Tim Talks. This conversation is about how a specialist deep tech venture manager makes their edge. SmartGate VC, their Fund 3 right now is aimed squarely at the intersection of physical AI, secure edge and brain-computer interfaces. And there's a strong Armenian connection, which is interesting and a little unusual, as well as the Southern California ecosystem backbone, if you will. Welcome to folks from SmartGate right now. We have Ashot. Let me see if I can pronounce this properly, Ashot. It's Arzumanyan?
Yes, correct.
Okay, Arzumanyan, Ashot. And then we have Areg, let me see if I can get this one. Alimian?
Yes.
Is that right? Alimian?
Yes, absolutely.
Okay, so I did it. In any event, Ashot and Areg have interesting backgrounds. Ashot comes in with a deep tech and tech transfer architect, and he's a co-founder of the firm and really an early backer of science-born companies and one of the people who turned a regional network into what they are claiming is a real genuine sourcing engine. So we'll see how that works. Sitting, I guess it's in another room, we can't tell, is Areg, who's an operator turned investor, and his background spans co-founding and exiting a hardware company, leading security products at Box, and running large M&A and product lines at Keysight before teaming up with Ashot at SmartGate as a partner. And the goal here is to get beyond the buzzwords and understand how SmartGate manages the risks and rewards in deep tech VC. Welcome, guys.
Thank you, Tim.
Pleasure being here.
Let's start with a thumbnail sketch of your backgrounds. Where'd you grow up? Where'd you meet each other? Areg, why don't you start, and then Ashot can weigh in.
Yeah, I grew up in Armenia up to the early age of 17 when I got a scholarship from a private university in Southern California to do an electrical engineering program. It was a full scholarship, defraying tuition. So I moved there on my own, maintained 4.0 GPA. And then when I was 20, I graduated, sent 500 resumes. Back then, internet was not as prolific as it is today, and got a job in Silicon Valley, moved there, was writing complex C++ code to synchronize networks. So that's how I got my start. From there, I had opportunity to work across different Silicon Valley companies. I joined various consortiums, including IEEE, where I had the opportunity to co-write the Wi-Fi spec and multiple amendments therein that we use today, security and quality of service. And there I met my co-founder at the time, Fanny Mlynarski. There was a lot of issues with Wi-Fi and roaming, in between cellular and Wi-Fi networks. So we had opportunity to design a test system that would test the handsets and the network infrastructure. That company later exited to a large Japanese conglomerate. And then since then, I've been running P&L and large organizations, product organizations of publicly held companies. You named a couple of them, Box and Keysight. So it's been a great journey.
Wonderful.
Yeah, that's showed my background.
Yeah. Ashot, your turn.
Yeah, my, what I call it, past life was very different from the world of technology. I used to be in investment advisory and management consulting, very big variety of companies, not necessarily in the world of tech. a PhD in economics myself. Also was born in Armenia. In a way, I keep the link with Armenia very, very strong. I'm there quite a lot throughout the year. Last 15 years or so, I'm into deep tech investing. I found this new world for me, the world of startups, around 10, 15 years ago, and started to dive into it. And I was amazed by it. It's really the world where the sky is the limit. And basically, it's not zero-sum game. You disrupt the status quo, you change how things operate, and it's all possible. It's not a dream. Like, it's dream, but you can make it come true. It was fascinating for me. I got into it and eventually co-founded SmartGate to specifically invest in startups and help founders join their journey and move forward on that trajectory. So yeah, that's where I am.
Terrific. Ashot, this one's for you. So your latest fund, or Fund 3, anchors, I think, on physical AI, secure edge silicon, and brain-computer interfaces. So what are you not going to do that every other AI venture fund might be tempted to chase over the next 3 to 5 years? What areas are you simply not interested in?
Yeah, this is a good question, but let me a bit of zoom out here. When we were starting our first fund, our focus was AI. It was 2018. It wasn't like the thing it is today. Like, when it's not that everyone was talking about AI. You may remember blockchain and other stuff that was so popular then. But we believe that you need to invest ahead of the wave, before the wave is there, before the full hype is there. That's kind of our model, our genesis. So if you position yourself at the place where the wave is forming, once it's there, you can tap it and you can have a formula for outsized returns.
That almost sounds like surfing.
Yeah, it actually is. In a way, we are surfing VC in that perspective. Like, that's how we see us. So now, when everyone is talking AI in the world of software, let's put it this way, when agentic AI is taking over, and it's really very massive opportunity. Our perspective is a bit different. You can ask ChatGPT to edit your email, but can you really ask it to prepare your morning coffee? Not yet, right? But this is going to come, and this is where we stand. Like, we want to invest in the areas to construct a portfolio. So once this moment is there, we are already prepared, and we have a portfolio company that can tap that wave. So if you think of it, physical AI, which means robotics, sensors, actuators, control systems, intelligence layer around that. So this is our one core area we focus at. Then cybersecurity perspective. Everything, if you want to have implemented in real world, it needs to have the security layer for it. So there are going to be very new security challenges and new really massive companies in that area. So again, we are covering that domain. And now let's go a bit of sci-fi. At some point, our brains are going to be connected to the cloud. Now, this sounds like really far away, but here is the thing. There are many diseases that can be addressed right now with neurotechnologies and brain-computer interface technologies that have their real path to reimbursement, their current market opportunities. That's where we focus. We have very good downside cover scenario. But when the companies like Neuralink, at some point, scale, and they need scale, and to get to humans, we will have the portfolio that is already FDA approved, that is already in humans, and because of their current neurological disease conditions that are being addressed, we will have that portfolio, and that's again a formula for outsized return. So again, we are also in brain-computer interfaces, we are targeting this position ahead of the wave that we believe is going to come very soon.
So anything outside this security, physical AI, and enabling technologies, picks and shovels, if you will, security related stuff, and then the brain-computer interfaces, anything falling outside of those general areas is something that's just not your cup of tea, not your kind of deal?
Yeah, if something falls out, you simply never chase it. Opportunistically, sometimes very interesting things can come your way, but you never chase it yourself, because you need to be disciplined around your thesis and basically follow the right portfolio construction. So that's where we are. We never chase ourselves things that are outside of our thesis areas.
So, Areg, when you guys talk to CTOs right now, what's the one thing they're excited about in AI that you find overhyped, and one thing they're quietly worried about that the market mostly ignores?
Yeah, over the last several years, they have been excited about the infrastructure and the level of and how it enables at scale disruption to productivity of their businesses, right? So how can you infuse AI in every fabric, in every element of the businesses that they run and support, so that they're not behind the wave? We've already seen tremendous gains in productivity that AI has put in place. What they're quite worried about, candidly, is how will this hit production? What type of security and governance issues will it manifest? And there are a ton of companies that have emerged that what we call our AI wrappers, or what the industry is known to identify. And back to your earlier question, we try to avoid those, Tim, because the barrier to entry to how a competitive startup can emerge become very minimal. So it often, a lot of the companies were presented and we see have a very little barrier to entry, and it becomes an execution game. And some are really good at executing, others not so much. But one of the fundamental qualification areas, how we look at the sourcing and selection, signing the portfolio companies, is how difficult of a problem are they solving, and how can we generate outsized returns, right? How can they really generate value? We're technologists, we're operators, so we really understand the elements of the technical stack. How much of technical merit does this proven technology, in a proven way bring to?
In that context, how often do founders' roadmaps for deep tech companies survive first contact with the real, actual technical and perhaps regulatory reality? And what sort of adjustment conversations do you commonly have with them?
Yeah, often we find there's a thesis and there's a disruptive technology that founders have created. Often these emerge from leading universities, which we work with. We work with top 20 Ivy League schools. And there's a bit of a gap that while the technology can be created to solve a particular problem, it's not very often that it can survive at scale, right? So, there are teams that we find are incredible scientific minds, and they create disruptive technology in radar, in LiDAR technologies, in optical sensing, in industrial automation. But to really take that and scale that so that cost economics makes sense at scale, the go-to-market aspect needs to really come together. And that's where we find there's a bit of a gap.
Yeah. Ashot, from your vantage point in security and infrastructure, what do you think? What's the current market overestimating right now, and what's it's dangerously underestimating? And how does quantum computing fit into that? You see, tremendous advances being made in the management of the very slippery technology. And people do say, for example, that the blockchain and crypto universe gets massively rocked when if quantum computing can crack all the cyber related stuff. But apart from that, as well, what do you think the market is overestimating and underestimating at this point? Where are we in terms of the way people are looking at AI security?
Well, it's a very good question. I think markets generally have the right feeling that something is massively changing, right? So, and we are in a situation where the philosophy to understand where we are versus the progress of technology that is happening, there's a gap. Like how you comprehend what's going to happen, education. What's going to happen to universities? Are we going to need them the way they are right now? What's going to happen to workforce? AI is automating junior positions, basically. It's let's say at some point it may be automating seniors, but like at a very short-term perspective, it's automating junior positions. So if junior work is automated, how someone becomes ever senior? There are so many questions that are kind of in the air right now, and they are fundamental social, economic questions. It's very hard to underestimate, and I think really it's a very, very massive turnaround time happening. There can be overestimations or underestimations at certain points, but at the big picture of things, we are into very massive changes, and the way the world will change won't be recognized.
Do you think the agentic, I don't know if you call it revolution, I suppose it's certainly an interim revolution at this point, but do you think it has specific security risks that are unrecognized, or are people really furiously working on the security risks associated with essentially a piece of software that has a mind of its own to some degree, has some agency, right?
I think security risk is basically the key bottleneck for enterprise adoption right now. If you think of it, like why don't we have all these AI agents already fully deployed at the enterprise scale? One of the things is this security, and security broadly defined, right? Not from only hacking perspective, but also security of expected results, whether your intended result versus what the model gives you is the same. So guardrailing the models and actually securing the prompt injections and other dimensions there. Once you clearly solve this part, you basically make it ready for full-scale enterprise adoption. So that when you can give an agent transaction level data, not only read access, but also write access, and be confident on what will happen tomorrow, that moment will be a game changer for enterprises.
Well, certainly small language models can keep the primacy of the data in the enterprise itself, and particularly if you push it out into edge devices that are only accessible to people within the enterprise. But part of the agentic question, I guess, is contextualizing their responses, which I don't think we do very well right now. And if you train something on a very specific process, and yet you break down the process across time for actually getting whatever it is done, you'll find that there are lots of miserable little interim processes that have to be accomplished all along the way. with decision trees and algorithms that would apply to all sorts of contextual problems. And I would think that, that this is certainly from a security perspective, it's a critical element of this whole thing. But also just from a practical perspective, I think we terribly underestimate the complexity of the kinds of things that humans do in their agent capacity. And it's hard to see how contextualizing all that is going to happen in the near term, although in the longer term, I think it's probably inevitable. So what do you think about that? I mean, respond to my idea, because I do think that this contextualizing issue is big, or appears to be big, certainly in my use of the tools.
Oh, yeah, I just quick note here, like the context issue problem is present whether for humans or agents. It's there, right? If you don't provide a good context to your team member, a human, you won't get the results as well. So giving the right context is almost like majority of the work you have to do what comes to AI agents. Now, yeah, this is something that has to be solved. And the expectations we have from AI right now, at least for midterm, is junior work. So AI is not supposed, at least for next few years, to automate senior work. So the experienced person, the human in the loop, is going to be needed anyways. The issue is like, if all the junior work is automated, how does someone become senior? And that's kind of the problem for society, education related, and generally talent nurturing related. But Areg, I believe you have things to add.
Yeah, Areg, across your current portfolio, what company do you see taking the biggest, boldest technical risk, and which company is taking the boldest commercial risk? How do you think about those two kinds of risk in those circumstances?
Yeah, this is an excellent question. We have 42 portfolio companies across our funds, and entering into Fund 3 this year. That number is certainly going to increase. We're seeing, if you look at the three primary directions that you outline: neurotechnology, AI, and the cross-section of the physical world, and AI and security, we see some very interesting bets in innovation with neurotechnologies. For instance, how do we access the brain? And these are companies that are solving what's not been done before. Ashot opined on the impact of neuromodulation earlier to disease-modifying outcomes, such as Parkinson's, Alzheimer's, and others. We see some solutions working with some of the best neuroscience teams in the world, where an injectable microscopic device can cross the blood-brain barrier, embed itself in the vasculature of the brain, collect data, remotely transmit that data to outside of the head, and analyze that data, and very surgically, through neuromodulation, impact things like chronic depression, neurodegenerative conditions, chronic pain. So these are, you can say, very risky bets, but if and when solved, we're already seeing some really, really impactful outcomes. Everything from accessing the brain without drilling the skull to going after certain clinical indications, such as treating hematoma or evacuating hematoma, or going after epilepsy conditions or treating severe tinnitus, that can fundamentally change longer-term impact of these currently unsolved ailments. So those bets that we've made across the board, from accessing the brain to collecting data and then very surgically modulating part of the brain, that are already proving to be very, very effective in treating conditions, are, you may call them moonshots, but moonshots within line of range where we could see these outcomes. I'd say those would be perhaps on one end, and to Ashot's point and kind of the genesis of how we really make these bets. Biotechnology in general and specific neurotechnology subsection within that is really at the very early innings of what would become possible. Neuralink has gotten a lot of recognition because of the people behind it, namely Elon Musk. But you've seen some other recent Sam Altman investments for accessing the brain. It's really at the early innings, and I want to say, multiple years already in this journey, with having established very deep, profound relationships with some of the top labs, university labs, some of the best scientific minds in the world. And by making these early bets, when the broader wave catches up, we would already be 4 or 5 years in this journey.
So that would be one of the boldest technical risk profiles that you're currently facing. What about the commercial risk? What do you think? How do you think about that? It's a different sort of a thing.
Commercial risk, certainly. Well, if we kind of expand beyond the neurotech, there are bets we're exploring where people are looking to solve how vulnerabilities are detected in binary images. Right now, that's a very complex problem because a lot of unknown issues emerge because of supply chain issues, how you link to what type of libraries, and these vulnerabilities can be exploited in different environments, in embedded systems, in digital infrastructure, in enterprise software. And the research and the applications and the approaches that are being done to effectively minimize these vulnerabilities and more effectively go through the whole DevSecOps process, there is certain commercial risk, and certain teams are betting on the right level of access and go-to-market strategies within the government and as well as the commercial space. When executed correctly, it can have incredible, profound effects and really significant impact, even from improving the efficacy of how issues are discovered in software, all the way to finding zero-day vulnerabilities that are very, very materially important to critical infrastructure and solutions out there.
Mm-hmm. Interesting. Ashot, here's a question about your funds and how they're doing. You show really strong paper multiples. I mean, the markups on small pre-seed checks have been impressive. How does that selection and access edge survive when you scale it? In other words, here you are at pre-seed and seed, investing a few $100,000, moving that needle to a $5 to $7.5 million kind of a number is a different order of magnitude, really, right? How does selection and access affect that, and how is it affected by that? And is there concrete change you've made in how you operate to be relevant at Series A and B, and not just at the first check? I mean, how do you view that?
I think, look, in venture capital, there is one very strict rule, which says every investment you make should have the capacity to return the fund. Now, as you rightfully mentioned, when you do a pre-seed investment, your criteria can be much easier because you can make 50x return, let's say from a $100 million exit, right? If you do the right small bet at the right time. As things progress, you really need to look at the scale of the exit, where the capacity of the company for exit, the market it addresses, the level of first principles problem, if it's a deep tech, the level of first principles problem it's solving, defensibility. So there are many things that you look at, and in combination, you assess whether this is still remaining that type of a company that can be a fund returner for you, and the scale of the opportunity is that big. Obviously, not all the companies are going to be fund returners, right? But in every scenario, you look at you want to see a scenario where when things go right and executed right, you, without any dreams, realistically get your fund returned. So that's how we approach. That means as you go further in the series, whether it's seed plus A, and later, you have to look more and more strictly where this can go, like how big this can become, and what the exit can look like for a company like this.
So a very common path with early stage VC investors is born of frustration, because you get your pro rata rights, but you don't have the capital to pile into the handful of companies where those pro rata rights make a difference. And in response to that, lots of GPs actually, they go into later and later rounds, and the pre-seed, seed, and pre-seed activity is still there, but the frustration of not being able to pile in with a pro rata, it stings, and you see something become a unicorn and beyond, and you can't do anything about it. Some folks, will change their strategy for a subsequent fund. We had a client at one point who had an early stage strategy, and they decided actually their network of contacts in their domain were much more appropriate to a little bit later stage, so they could actually talk to senior C-level folks in acquiring companies, and the company would be ready to acquire as opposed to being premature. So how do you think about the pro rata, and how do you think about the, making your, the limits of your current model with respect to follow-ons in these really exciting companies?
You point out a very painful part. Like, we have been observing so many of our companies progressing, making really great up rounds with really great investors. But our discipline of limiting ourselves to a certain maximum ticket size per company would stop us from participating in those rounds. Or like, we could have a bigger ticket in the company, but again, we would limit ourselves to a certain ticket size just to keep the diversification proper. So this is really something like a pain we have seen. I think and raising SPVs and reaching out to a network of LPs, etc., for every single deal. That's a different kind of challenge, and it's time consuming. So we clearly, we with this new fund, what we are doing is we have this follow-on piece embedded. It's a separate vehicle per se. It's optional, but our investors have the opportunity to invest in this optional vehicle as well, so they can tap on the pro-rata opportunities that our fund ecosystem provides. And in really best opportunities, because not every pro-rata is right for your strategy and the return profile you are following, right? But those that are meeting our criteria, and those will be tapped by that embedded vehicle, and our investors can have access to it inherently.
If you think about every pre-seed portfolio company being a fund maker, then, and you're only going to have a small number of those within the larger group of portfolio companies. Obviously, not every company is one where it's the decision not to participate in pro rata doesn't have to be painful. It could be, I guess we dodged that bullet. So there's other ways to look at it. Areg, shifting a little bit here. So having sat on the operator side of M&A, what do you try and install early in your portfolio companies to make them more acquirable, make them more attractive to potential acquisition? Because that's, particularly when the IPO windows are closed, you're going to sell this to somebody, another technology player, or somebody who can use it in their another business. What do you do with these very early stage companies to try and position them to be acquirable?
It's actually a really great question, Tim. I've overseen close to $500 million of M&A, closed M&A deals in my life as an operator. It's interesting drawing that parallel to our investments. I'd say it's a multifaceted, kind of a multi-pillar approach. One, do they have the right technical team that has built a defensible product that's truly differentiated and can really withstand some of the competitors emerging in the space, right, that could challenge this technology. So the technical merit of the product, of the technical stack. Second is this team equipped to go and knock on the doors and really execute on the go-to-market strategy? That's so important. Have they really identified the right markets to execute on? Are they getting into some of the design wins early on so that they have enough of a focused product to go after these markets and really with solid execution and the right team behind it? Because I talked about very super technical teams that don't often have the business development persona within or the right CEO persona that can really execute. So defensibility is super key so they can really not die and be there in the long run. How do they manage their follow-on investments and investability in follow-on rounds, right? How are they managing their cash flow and their P&L are some of the other important elements that we consider. And one of, I'd say perhaps a more important area we look at is, can this be a standalone business? Can this be $1 billion standalone business that on its own can really withstand, irrespective of what the exit path would be, merger, acquisition, IPO, if that's the path? And do they have all the right dynamics and the DNA to get to the $1 billion scale, with interest from follow-on investments? How many rounds do they need to invest? Do they need investment to really get to that scale? What type of revenue multiples would they really command in the industry they're in? So we look at all of those dynamics and really plan that horizon and trajectory to ensure that the defensibility is there, the right team composition is there, the right access to markets is there, and with all the underpinnings, there's solid enough of a foundation where they can get interest from strategics, corporate venture capital, and ideally downstream blue chip VCs. We have generated over $350 million of follow-on investments for our portfolio companies because a lot of those elements were examined and they were investable downstream.
Mm-hmm, mm-hmm. So Ashot, here's an interesting question that I'm sure you guys come up against. So if you're looking at a new opportunity with maybe a slightly weaker science profile, but a very strong team, versus a world-class science profile, but more of an unproven team, how do you think about that? How do you balance those elements out? Which do you prefer if you had to pick one, and why?
Yeah, first of all, I think there's one important dimension to mention. In deep tech, execution and science are multiplicative. It's not additive. So it's not one plus the other. It's you multiply with each other. So if science is weak, fundamentally, team cannot do too much there, right? So if your molecule is toxic,
right, but I'm talking about something slightly different. In other words, just a little weaker, just a little stronger. One's team is I mean, how do you view the science versus the team? Let's assume both of the science related issues are real and proven, and just one is just world class, and the other is interesting and real and tested, but not quite as world class, if that makes sense.
Yeah, I think here is one thing that everyone should be very careful about pre-seed investing in science. You really want very, very top scientific team, which is open enough to involve operators later on. So if the PI, the professor, has the mindset which is open to invite CEO when the time to take it commercial is there, and is kind of open enough to network to the right people so that when the time comes, they can be onboarded. That's the key. So ideally, you want this very top scientific team that is open enough to get the operators at the right time. Because at the very first phases, when you are in the scientific incubation, let's call it, when you build the science, you don't really need someone who can go and talk to all the top pharma companies. I'm talking now like life sciences, but we can go the same on the deep tech end, right? So at the scientific incubation phase, you want really very good scientific strategy, like research strategy executed. But the team that is executing it should have this feeling of network building, this capacity of being open, so that at the right time, right people join the team and make the execution bench. So that's I think this should be together.
Yeah, the things that fascinate world-class scientists typically don't involve the prosaic operating details of a business. They're much more keyed in on, wow, look at this. I want to know more about this. So that's a very interesting and I think important observation. So Areg, let's talk about liquidity a little bit. I think cybersecurity, you've talked about as sort of being 3 to 5 year DPI engines. I suppose that's because the market is, is really hot or desperate for answers, particularly if there's been problems. But if M&A slows or stays slow, what element of that liquidity thesis breaks? How do you deal with that?
That's a great question, Tim, and it comes up from our investors. How do you really return, generate DPI? So we we have kind of two investment profiles: the longer term bets, such as Neurotech, that are constrained by regulatory approvals to take the solution to market, and then some of the other ones, I'd say on the far end, would be enterprise type cybersecurity deals, or deals that impact, or solutions that impact the physical infrastructure. The reason that there is a lot of interest in solving these more complex problems, such as agentic security, or putting guardrails around permissions when you deploy agents in an enterprise environment, or looking at physical security of industrial infrastructure and a lot of those IoT devices therein. There's a couple of ways to generate liquidity. Number one, there's a certain amount of interest in secondaries for those particular deals. If the particular company is doing well and they're growing their revenue and they've generated substantial customer base with Fortune 1000 repeat revenue, we look at those metrics, right? Has the company performed and executed? Do they have enough of foundational technology that's solving those real challenging problems? Most recent is agentic security or agentic security identity and so forth, or some of the more complex issues with finding vulnerabilities in chips and hardware devices. These companies, we don't necessarily look at if it's cybersecurity, it needs to return and generate liquidity in a 3 to 5 year time frame, so long as the company is healthy and is really executing and is built for scale, right? Because those are there are, of course, up rounds and markups that are notable, and we share with our investors and in our semi-annual reports. But the core of this is, are you building a strong foundational company that can really scale on its own, irrespective of what that return timeline is? And now we've been fortunate enough that our LPs, our investors, are quite understanding of that. They can see the strength of the portfolio. They can see the technical merit of the solutions they're in. They can see the quality of customers and the net retention rate of the customers. And those are some of the, perhaps short of saying, all right, what's the DPI across the portfolio? How healthy is that portfolio? How strong of companies are you building that are growing and are solving really complex material problems that are very, very important, not just today, but in the next 5 to 10 years to come?
Yeah, and yet, as you move up market in terms of investor size, particularly, I think you'll find that that they definitely want to know and be reassured that everything is being reported transparently and there's enough progress in the underlying for them to be patient. But as you, I'm sure, know, VC fundraising has for a while there, we saw a spate of fundraising, particularly for AI and LLM related stuff, and some of that's just way out of scope for venture strategies. But venture has not not been returning a lot of capital, and even if those portfolios are solid, LPs get antsy. So I think as you go up market, you'll find this becomes a different problem, and one where you've got to modulate your own beliefs and desires. And secondary, as you mentioned, it's interesting because particularly in early stage venture, when a portfolio company gets mature enough to be interesting enough to an informed, experienced co-investor, you end up selling out perhaps some of your highest conviction positions a little early, right? So it's a dicey matter, this whole distribution thing, and it's one where, particularly in your space, you need to manage it carefully. That's my assessment after looking at a lot of these things, and I would say, in terms of the way you position yourselves in the market and how you manage your portfolio, make sure that a portion of the portfolio is not is not as long dated and has much more near term commercial potential with a commercial team in place and all of that. So gratuitous advice from a placement agent. So Ashot, so you talk about capturing valuation discounts by working with teams before a term sheet, and that's an excellent idea, and you have to develop these really good relationships, interpersonal relationships with the founders and teams that you invest, no question. And doing that before you get to a term sheet, makes it easier to talk about valuation and easier to talk about terms. I'll bet there's been some times where that process actually convinced you the fair price was higher than you first thought. Is that correct? Did you ever come into something where after that sort of team building, team working, you said, you know what, these guys don't know what they've got? Does that ever happen to you?
This is actually a very interesting question, because what is value? It's not so. Sometimes, let's say, you can have a technical solution or a massive problem, But the execution part of it, so let's say if the team doesn't realize what value they have, right, that means there are a lot of gaps on the execution end that needs to be filled in, right? And so once you fill in, yes, you have all the capacity. So, but the thing is that it's constantly underestimated that it's combination with execution. It's not only the patents and the technology and everything you have in place that makes the value, but and when you miss out on the second part and you don't take it into consideration in your calculation, then yes, you can say, look, these guys have, I don't know, a new solution for energy problem that can solve the problems of this civilization. Yes, right. But if you are not the thing that is capable of raising and absorbing hundreds of millions of dollars to make that happen, then probably it's not going to happen, right? And someone who has that capacity, who comes on board, they should capture a lot of that value themselves. And then things become fair. So my point is that this is sometimes counterintuitive because people would think of technology as the source of ultimate and the only source of value, but that's not true. Execution is also there. And if there is within the team, they don't understand the level of the goal they are sitting on, that's actually not fair, because if they don't understand it, that means there is a lot of cognitive work and time is the most valuable thing. So they need time to get there, and that means a lot, basically, and then everything is fair.
That sounds a little like when there's a certain amount of time you have to put into the deal, obviously, but how do you avoid the trap of sunken cost fallacy, where you spent so much time that you feel like, oh man, we really have to invest now? Do you ever run into that sort of issue? And it would be in retrospect, I would think. In other words, you obviously wouldn't make the investment if you knew ahead of time that there might be some buyer's remorse. But this is like checkbook discipline, right? Where you've got to decide whether or not you need to write another check to a company, and yet you've got this emotional relationship with the founders, and they trust you and you trust them, and it's just not working for you. They may still believe, founders typically do, far longer than investors. But have you ever had kind of post deal remorse where we just really spent so much time on this. We should have pulled out after a year or whatever the period was. Has that happened to you?
Actually, I'm thinking now in retrospect, probably no. And the reason is, remember I said how I was excited about the world of startups, and like how this was fascinating for me, and to get into this and investing and working with founders, etc. So this part of it, like the criteria number 0 for us is this the founder, the team that you really want to work with? So at the end of the day, even if it's team like that, if you work even a year with them and you are still not at a place where you feel confident investing, that wasn't wasted time, because you, like, at the personal level, you have this one life, you have your 24 hours, you spend this time, but you spend this time with really good people. And it's not a waste, because there is a lot of learning. It's not like you're spending time with really capable people anyways. Like, it's not that they are really experts in their area. So you have a lot of learnings yourself that you can internalize and apply to other things that you do. And then, so I think we never regret it for the time we have spent. And at the end of the day, maybe it paid back in a different way, through a different company, through a different relationship. But if you pick the very first selection is right, like if you really pick the people you want to spend time with, then there is one way or another, in the long term of things, you have a return on that time you have spent with people.
Yeah, makes sense. Areg, let's talk about the Armenian flywheel. This is kind of a sourcing advantage that's most unexpected. And I'm just kind of wondering, first of all, I want you to explain it a little bit as a sourcing advantage. It certainly doesn't sound like one. So let's start with that.
Yeah, Tim, it's great that you caught on to that. It's certainly helped us with sourcing. It's helped us in two ways, right? Sourcing and access, whether it's access to markets, access to early design partners, access to number of things. There are around 10 million Armenians in the world. I don't know what subset of that are in tech or are executives on the access side. But over the past 7 or so years, we've become fairly known in this Armenian community, certainly people in tech and the finance world. One of the areas it really helps us if there is disruptive, amazing technology that is being born somewhere in a lab. And it doesn't necessarily have to be in Armenia proper. There may be incredible teams out of Seattle. They're working on a next premier multimodal foundational model for the physical world. We invested in a company called Perceptron. It's published along with Bessemer. It is because of that Armenian flywheel that the gentleman, the co-founder of that company, came out of Meta Fair Project, was one of the lead scientists there. And I think the first interaction was with Ashot, where he came to an event in Southern California. We've hosted, something like 350 or so such events for the local tech community and for the tech ecosystem in the last half a dozen years or so. You build those relationships. Part of that is the Armenian affinity, right? Because you kind of build this camaraderie and people return and they follow you and so on. And you get access to those incredible deals because you don't necessarily have to go very proactively know everyone and look for it. So part of that brand recognition, including the Armenian affinity, together collectively helps us to be known and helps us kind of creating this pooling effect where, you generate reputation of integrity, of honesty, of having this pedigree of institutional quality and grade of investments. And I'd say more importantly, of really going above and beyond for your founders. As Ashot pointed out, sometimes we'll invest a year in a relationship, often generating a lot of value for these founding teams, from their initial business plan to go-to-market strategy to finding a PMF and so forth. When coupled with that extra edge, in this case, the Armenian affinity, it really helps produce results and give us access when otherwise it may have been difficult because these the case I mentioned with Perceptron, super oversubscribed round, led by a blue chip VC, and we got an opportunity to write the first check.
So when you sit with U.S. strategic, what would be the most persistent misconception about the Armenian network, and that you find yourself correcting?
There certainly aren't anywhere as many Armenians as there are, let's say, Indian.
Maybe any. I mean, there are very few, but do you know Armenians in deep tech venture? Others besides you guys?
We do. We've in fact funded. That is a clear misconception. There are incredible Armenians in the world historically. For instance, the creator of the famous Russian MiG fighter jet is an Armenian by origin. There are many other Armenians, acclaimed scientists around the world that have invented incredible technologies from defense to biotech to space tech, etc. So we recently funded a startup, again, through the Armenian Affinity. This is perhaps one of the best teams in the world that have specialized knowledge in designing actuators. And as you know, Tim, actuators are underpinnings of current robotics, humanoid technologies, and quadrupeds, and so on. So we haven't really announced this, so I won't mention the name, but they have incredible innovation in some military and dual use first aid technologies, where you would send a robot to, let's say, an explosion site. And yeah, this is a team of PhDs that also had worked in the government sector that have designed this absolutely incredible technology that, we believe would be perhaps an order of magnitude better than really anything else out there, including the current leading products from Boston Dynamics and Ghost Robotics and so forth. Might be given out a bit too much on a public forum, but yeah, a good example of deep tech. Armenian. Well, one of the founders is not, but the two co-founders are, and I don't think we would have really known or had the level of relationship had it not been for the kind of initial Armenian connection, and then the camaraderie and the trust that was built over time to invest in this.
Right. Ashot, when you ask your best founders why they chose SmartGate, what do they say you did for them that bigger brand name VCs didn't or couldn't or wouldn't?
Actually, that's a good question. I never asked that question in that way.
Okay. Do you have an intuition of what they would say?
Yeah, the reason is, by the time we invest, we usually have some kind of a really intimate relationship and knowledge of each other. So it becomes so natural because through different discussions, brainstormings, and process we go through together, it's usually becomes so natural at that point that we should partner up and work together. So yeah, so I think it certainly is our dedication to them, to their success, and availability for them when they need us. That should certainly stand out among the answers that they would give.
Interesting. Yeah. So, Areg, when technical science-oriented founders want to build too many products at once, I'm sure you've never seen that. What do you do to help them focus on what you think is the most important path to take without damaging the relationship?
We don't take a prescriptive approach. We take that of a peer who have made mistakes in our own decisions, building products, taking them to market. So, really it's spending the time to understand and often whiteboard why have they made these decisions. If they're building multiple paths that requires access to different markets, bringing it down and really parsing, do they have the knowledge and access to these end markets? For example, how many different product lines and how much differentiation do they need to put? What is the resource structure to support all of those products? So it's really kind of breaking it down to, the first principles of what would it really take to succeed? What are the risks involved? And if we already have the answer to give, we don't necessarily start with the answer. We really help them break it down and visualize. And often they see that, well, with the current level of funding and the current budget and the runway that they have, going after these markets would put them at a disproportional risk, and rather it makes sense to really focus on one. This actually happened with the particular robotics company that we discussed, because they wanted to have a dual strategy where the same actuators are really used. You can build a manufacturing arm, or you can build technically a humanoid, or you can build a quadruped, but these are different markets, right? And if you try to boil the ocean by simultaneously embarking on these different markets, sure, there's about 70% overlap in your tech stack, but how's your cost structure? How much focus dilution will you really have to manage? And more importantly, how are you going to go about simultaneously developing early design wins in those respective markets? And it became obvious that, you got to drop one. So if you're picking one fundamental area to make the most win, do you go after the commercial space? Do you go after the government space? How much headway have you made in one or the other? And what are the chances that when the time comes for the next fundraise where you really want to show enough markup because they don't want to get diluted, they're very sensitive to that. What is the most impactful first product that you could have built by that time, and what are the chances of success of getting those early customer wins? And when you break it down and just really illustrate across many product families.
Yeah, that sounds like a winning narrative to a founder, particularly the anti-dilution notion of focus. I think that's absolutely right. And laying out the facts. These people aren't stupid, but they still often want to do more, a bigger appetite than a budget, and otherwise they wouldn't be doing what they're doing. I mean, when you think about it, they're very creative people, and sometimes they're off in 10,000 different directions. So you guys have to help channel that energy. So for each of you, kind of curious what you would think would be the sharpest, most accurate criticism you've heard about your strategy, and what did you change in response to that? Would you actually change? Ashot, why don't you start with that one?
Oh, very, very good. Let me think of this question. So I think this changes over time, right? So the way you start something at the beginning and you evolve over time, you learn from every mistake. Like you grow and then outgrow yourself over time. One thing that I can say, like from my journey and from early days to today, in early days, you would think that kind of miracles are possible in the world of startups, right? So like you can actually make tremendous success, and it's in a way of a miracle. But you learn one thing, that there is actually no miracle. It's a combination of very important facts that happen, but everything is superpositioned for that success to happen. And you over time sharpen this way you look at things, the way you assess the superpower of each team, the way you assess the external environment and how they are well positioned to capture that. So I think one thing that is very clear that over time evolved, that we certainly do specialize on things that we invest in, and we don't do things that we don't know well. Mm-hmm. So you really need to stick to what you know well, because these things that can be very shiny, if you know well, you dive a bit and you understand that there are a lot of catches behind the shiny, things that you wouldn't know if you are not specialized. So knowing what you are doing and not doing things that you don't know by just the excitement of the shiny things. I think that's a learning that came. It's kind of apparent, right? But you still sharpen it over time, and I think this is what I can say from my experience.
You
this is
not
what
only
happened.
have to tolerate ambiguity. I think you have to go a little further than that, and I appreciate that. Areg, how do you answer that?
Yeah, it's amazing question so far, Tim. This is a good one too. I'd say there are two things that have come up. One is, investors who really love that DPI and they're like, well, enterprise SaaS, you're likely going to see these outsized exits in a short time frame. Why don't you just be open? Why don't you be a general fund and pick these enterprise deals? You clearly have the experience, and make me feel better. It's just don't delay deployment and really accelerate it, and just take every deal, or at least expand the horizon significantly. So, of course, we've realized, to Ashot's point, it's then harder to differentiate. Number one. Number two, your downside risk, because you can't possibly know every one of those domains as well. It's not just Ashot and I on the investment committee, or our venture partners, or our advisory network, or even the operating team and the analysts, the principals we have. We have a wonderful team, but there's only so much you can do. And there's, we use this whole model of how do you source, how do you sign, how do you scale, and how do you summit, basically the entire trajectory of this. So if you're not specialized and disciplined enough to turn away deals, even though, could this enterprise 2-year-old startup have had $100 million exit? Yes, we see those and we are aware of those. But if we're diluting our focus, we can't develop enough differentiated strategy, whether it's our internal know-how or access to markets, or our advisory network, or the whole flywheel. How does that really effectively work? That truly allows us to be focused, to really minimize the downside risk while really keeping the upside to outsized returns potential quite high, right? To the point of a single investment returning the fund. So we've had those conversations. We've had to really stand our ground with some LPs who really challenged us, and not really kind of getting arm wrestled down to changing our core thesis on how we invest. And the second challenge or criticism, that may have not criticism, but really more of a question. How do you think you can manage a bigger fund? Because GPs, just like founders, build products and they get really excited about building multiple directions. What makes you think you have earned the right to manage, to lead deals, co-lead deals? You asked earlier, going from 500K or smaller checks to bigger ones. The answer to that is, well, for one, candidly, hand to heart, we've matured as investors. I come from a background as an operator. I've managed billion-dollar P&Ls. Ashot is a seasoned investor who's come from, private equity, and now has been connecting the dots for a while. Second, you've really built an amazing team. When you build an amazing team, and the level of due diligence we do today, Tim, looking at, defensibility, IP, markets, qualifying, a lot of things we talked about during the show. It's basically the same amount of work that we put in place, irrespective of the check size. And we discovered over time is that when you're putting this much due diligence and understanding of the deal, of the markets, of the teams, of the relationships that go along the way, we're really well positioned. And if we look at the last 15 deals, for example, we could have led those deals, because you also learn, how to really price those rounds and so forth, setting the terms, and yeah, and I think that's kind of second clear thing that's come up mostly from investors. We feel reasonably confident and yet staying humble that we can manage this.
Yeah. No, there's no question that you have to design your strategy, adapt it to the circumstances, continue to evolve, but stand your ground. And not easy, because your investors are the ones who provide the fuel to make all this work. So is there anything you'd like to add to this as we wrap it up, Ashot? Is there something that I've kind of missed and haven't asked you that might be intriguing for our audience?
I'm thinking one part of it would be like how we make decisions. Right, that's like final decision. It's two of us on the core investment committee right now, and that's I think important part. And to elaborate on that, I think what we do, we need to convince each other to make the final decision. So, and we never do a compromise. I think that's very important. So you never
a team-based collaborative decision-making approach.
Yeah, you don't make a decision just to accommodate the situation. You need to be very firm in your position, but also open to change it. And when you have these two things, you can have quality decisions. So you should be open to be convinced, but also very strict on your logic and how you follow your principles in decision making. I think we both of us kind of follow this logic, and that helps to making quality decisions. So yeah, that's one thing perhaps I would like to add.
Okay. Didn't cover decision making. Got it. Areg, go back in time to when you were just getting out of school and starting into the world of commerce and all of that. Give yourself some advice. This is the final question. What advice would that be?
Don't be afraid to take risks and fail.
Okay, don't be afraid. You know what? I've taken that road. I don't think anybody in these markets who has succeeded consistently, deserves to stay in these markets. There's just too much unknown, too much non-linearity, and so forth. If you haven't failed, you really haven't been applying yourself properly. Well, fellas, thank you so much. This has been fun, and I hope you enjoyed it. And I'm sure we'll stay in touch. So appreciate it. Thank you.
Thank you. Really, really great questions. Enjoyed a lot our conversation.
Super. Appreciate it. Thanks, Areg, Ashot. Take care now.
Thank you for listening. Please visit us online at touchstonegroupllc.com.